Welcome to How to Build a Tent, the podcast about how to make you successful. My name's Matt Williams. Thank you for listening to the show. If you want to reach out to me, watch the show instead of listening to the show, you can find me, How to Build a Tent, on all the social media sites, YouTube, Facebook, Twitter, Instagram, and now on Minds. It seems like we've done a migration at the Fight Laugh Feast Network to go over to Minds. You can check me out there, give me a follow, and see our content there. If you want to email me, you can email me at matt@howtobuildatent.com. And we are part of the Fight Laugh Feast Network. Go over to fightlaughfeast.com, put in HtBT in the memo field, and you'll get a sweet mug. Plus, you'll get tons of other great benefits. I'd really encourage you to pray about, think about doing that as well. Got a lot of things to talk about this week, as I've mentioned before. I hope you enjoyed. Wow, this is going to be another long podcast. I hope you enjoyed the interview we had yesterday with Jenna Wellen. Please check out her art and see if it is something that you would like and help support her as she's selling her art online, and it's just really beautiful art. I just really love it. So thank you, Jenna Wellen, for listening to the show, because I know you listen, and also for appearing on the show and sharing your art with all of us. So we took a break and had that great interview, and now we're back into all the news. And I just want to touch on the trade wars a little bit because it's such a big deal, and it's impactful, not just for investing, but for businesses and all of the rest. It really is. And even just from consuming and buying products, it's going to impact us. And that's why I keep bringing it up. I hope I'm not beating a dead horse. There's just so many elements to this that it's really important for us to understand it, to be able to mitigate risk, take advantage of opportunities that could come from shifting dynamics from this trade war. And that is why I'm going to be continuing to talk about it. But the one thing I'm going to say, and we're not going to, again, harp on this very long, and I might have said this before, but I really want to harp on this, or I really want to emphasize this for you, and then we'll move on. It is, to survive this from an investing perspective, I think we should be investing in companies that are more in the services field. To me, it seems like that is a smarter play. At least that's what I'm starting to do, and kind of shying away from the companies that are producing manufacturing in China. And that just is logical, but maybe you thought about that, maybe you haven't thought about that, but I really wanted to drive that home, that I think one of the safest things to do, the safest plays, is to be investing in services that doesn't rely on manufacturing products from China. And I mean, you might get hit just from the overall emotion of the market taking you down, but I think those companies are going to be the ones to invest in until this whole thing gets straightened out. Something to think about, talk to a financial advisor about it. As always, I hope you've done that. That is really important, not just for investing, but for your tax structure and retirement, all those things. The next thing I want to talk about is car dealerships. And I might have shared this with you guys or not. I did share that I'm moving to Florida, and one of the things I'm doing is selling my car, and I am buying a car on the East Coast. And one of the things that just absolutely shocks me in this day and age, and I don't know why anything shocks me anymore, to be honest about it, is how non-transparent the pricing is for even new cars. Like, you kind of have a negative stigma of like the used car salesman, but even the online new car sales, it's really kind of amazing. It's like you look at all the discounts. They say like, oh, you can get this car for this price, $10,000, $20,000 off MSRP. And then you start looking at all of the like assumptions they're making. Like, you're a student, but you're also a veteran, and you've like been to outer space. And then you are also a, I don't know, an elderly person, whatever all the discounts are. And it's like, there's no way you could qualify for any of them. And then you start talking with them and negotiating with them. They give you a price, and then you have to ask, is this really the real price? Well, no, if you want, the 0% financing, then you can't get the cash credit. Like, but no, is this really like my out of the door price? And I'd say this not just because I want to complain, but although that does feel good from time to time. I want to present this problem to you guys for two reasons. One is, when you are buying a car, Don't be afraid to be as specific and repetitive as possible, asking clarifying questions. If you get on the phone with like a sales manager or something, they'll just spout off numbers. Make sure you're writing all of those down and making sure that you understand all of the prices. Don't feel like you have to rush into anything. Don't feel like you have to know everything, and then you have to feel like so this is what happens sometimes. It's like you feel stupid if you don't know everything that they're talking about, all the fees that they're in, like a doc prep fee. It's like, why is that doc prep fee in there for $700? Ask the questions. Make sure that you nail them down on their commitments and what they're saying, and don't let them wiggle out of it or just walk away. You should at least walk away once with every car purchase, or you're probably not getting the best deal. Now, the second reason I bring this up is because I bet there is a great opportunity for a car dealership that sells just new cars to give straightforward pricing. I know there's tons of apps like that, but when you actually go to the dealer and just list the prices, and what I mean by a great opportunity, I think people will appreciate it. People will refer you to your dealer more often. And then also the time wasted on salespeople working and negotiating and haggling and then going back and forth on prices and the distrust that's happening there, you're spending a ton amount of time that could just be resolved if you just had a really good price. And I just almost wonder if the margins that you make on cars from having this gray pricing where it's not really nailed down, is it really worth it with how much time your salespeople are putting into like negotiating and talking with these people? Or would it be better if you just streamlined it and you said, this is the best price that I can do, this is how much I'm gonna make the volume play, and just let my salespeople say, this is the no haggle pricing, and we go from there. There might be dealerships that do that. I've not seen one yet. I used to work in a dealership. Let me tell you, it is a shady place. But hopefully there are opportunities for good, value, honest, driven people to make a good income, make a living off of it. But there might be just some ways to reinvent how things are done. And again, culture eats strategy, and it's really hard to change culture. It's like a big Titanic ship. But if you could do it, if you could be the dealership that this is the price you're getting, it can't get any lower, this is what you're gonna get, it's a great deal, it's competitive with other people's prices, and you cut out like an hour or days and back and forth of negotiating, you might be saving a lot of money on the cost that you're spending on employees. Maybe you don't need so many salesmen because it is what it is. You don't need a salesman, you just need a consultant to talk to them about what's the features on this vehicle compared to another vehicle, and what you might like, what are you looking for, and matching you to products, instead of having these salespeople that are just trying to get as big a margin as possible. Anyways, there might be something there. So if you are looking for an opportunity to buy a dealership, that might be a good differentiation strategy for you, lowering costs and creating some credibility. The third thing I wanted to talk about is Amazon offer. And this is a really interesting article. Amazon says it will cover up to $10,000 of startup cost for employees who are accepted into the program and leave their jobs. If you leave your job and they're accepted, I think you should be accepted to the program first, then leave your job. Don't leave your job before you're accepted. They'll give you $10,000 to start your own delivery company, and they'll pay up to 3 months worth of your salary. That's pretty cool. It said the offer is open to most part-time and full-time Amazon employees, including warehouse workers who pack and ship orders. Whole Foods employees are not eligible to receive these new incentives. But what's cool about this is it's already created 200 delivery businesses. And this one person the AP spoke to said he opened his business in Atlanta, Georgia 8 months ago. And his company now has 120 employees, a fleet of 50 delivery vans, and makes up to 200 deliveries a day. He told the AP that he was hiring more people to prepare for the one-day shipping goal, saying his company is ready. So if you work at Amazon, if you are in one of their warehouses and you're wondering what could be your next career move, wow, it looks like there's some great possibilities here. And who's to say that you only have to deliver for Amazon? You think about their other competitor, Walmart, they're going back and forth. It's really interesting. Walmart has all the brick and mortar and they're digitizing their online process and learning how to streamline and appeal to e-commerce. And then you got this e-commerce giant looking to figure out how to build out infrastructure. And they're racing towards the center, which has both of them, the e-commerce logistics setup and the advertising and all that stuff, and having a brick and mortar. So hey, if you're an Amazon or thinking about this program, you want maybe to go get a job for a little bit at Amazon, see how the logistics works, and then go start your own company, you will get 3 months salary and $10,000 in startup, and you can deliver other people's goods too, not just Amazon. So that might be another great opportunity. That's a really great thing that's been coming from jobs or big companies like Amazon in the tech world. It's giving new opportunities, opening up new jobs, and increasing certain jobs, even though it might be, maybe bad for the housing market, quote unquote. Even though it's not bad, it's raising prices, which makes everyone who owns a house rich. But anyways, that's a great story. Continue to be looking for opportunities like this. There's going to be opportunities more and more like this as these companies try to scale and try to compete against each other. Another great capitalist story. Then the last thing that I want to talk about today is a video, and it's of Mark Cuban. He is a strong personality. Some people like him, some people don't. I actually really like him. He's even responded to one of my emails once. I felt so special about that. But anyways, I think this interview is really good. We're talking about Uber, and again, I've had a lot of comments about should I invest in Uber? And I say no. The only company that I have invested in that's been an IPO this year is Zoom, and so far it looks like that was a pretty good move. Pat on my back. But there's a few things in this interview that are really great. So I'm breaking it up into 4 sections, 20 to 30 seconds, and we'll talk about each of them. And I think it's really important to kind of hear what Mark is saying. Because remember, Mark is in the tech world. He has made billions off of being an entrepreneur, being an investor, and things like that. So he is a smart guy, even if you might not like his personality so much or the Dallas Mavericks.
What do you make of the whole thing with Uber, the way it's traded and the IPO in general?
I mean, it's not a surprise. It's not a growth company. It's not, it's a brand. It's an 8-year-old company, 9-year-old company. They just waited too long, and there's nothing exciting about it. Maybe they'll introduce something new. Maybe Uber Eats will explode and the numbers will show something incredible. But I don't think you could have expected anything different. Look, I don't know what the new business lines are going to introduce, but the reality is you're 9 years in and you're still having to buy your revenue. That's not a good sign.
He's talking about Uber and how they're having to pay to get customers on board. And at this life cycle, this stage of where Uber is at, 9 years in, they're still having to buy customers. And that's a big red flag. And sometimes we can get lost in the hype and it's a new IPO, we need to invest in it. But what we're starting to see is these companies that are really pushing out their IPOs as much as possible. And we're getting to a place like Uber where what more do they really have to grow? They're kind of already out there, and that's where they're at right now, and their dominance of the ride-sharing business is priced into their price. That has to make you wonder and ask the question, what am I investing in? What am I thinking they're going to do? Uber Eats, like Mark said, that could be a possibility, maybe one of those other kinds of channels, but is that really going to be the best place for you to invest your money? And we're seeing investors saying, no, it's not. And with the performance of a lot of these IPOs, they're just kind of run their course, and their hyper growth that you expect from these new companies, these riskier companies, is just not there because they're already a matured company when they're launching to the IPO. I think that's a really important thing to remember when you're looking to invest in some of these companies, is just because back in the day, if you owned Yahoo or Google when it first launched and there's oh my gosh, just what would it be today? It doesn't mean it's always going to be the same. Not every tech company is going to have that same return on investment that those early startups that we see today have been successful. And remember, a lot of them have not done so well.
The fact that, the whole gig economy is challenged when the overall economy and unemployment rates are low. and the economy is growing, because it's not a primary job for most people. It's the job of the last resort for most people. So they're looking to get, that increases the cost of finding new drivers. Again, I'm not saying that they can't accelerate, they can't fix it, but right now it's a challenge.
This is such a great point. And we were under such a bad economy for so long, 9 years. Oh, what was the last 9 years under Obama's economy, right? Where we were expected 2% growth. Unemployment was higher than expected. We were kind of just lagging out of a recession. And that is what made these companies, do so well, because they were able to get people that were working part-time to just pick up some part-time shifts using their car to make some extra money. But now that the economy is doing so well, they don't need these jobs as much, or not as many people need these low-paying jobs anymore, which means that they're going to have to pay more, offer more benefits, give more of their profits to these drivers to incentivize them to come. Or they're going to have to raise prices, and people are going to be seeing that it's not as competitive compared to the traditional cabs anymore. So they're in an interesting spot, and that's what Mark's saying. He's saying not that it can't be solved and not that it can be overcome. But I just thought that was interesting from two perspectives. One is the economy is doing well, and we're seeing it because companies like this are getting hurt. So for those thinking of investing in the Airbnbs, the Ubers, the Lyfts, just remember the economy doing well means that it's going to be harder for them to find drivers. And conversely, when the economy starts doing worse, maybe their stock will do better, and it'll be a hedge for recessions because more people are going to be wanting to drive, and it'll be cheaper to bring on new drivers. So just a thought on that perspective. Now we got 2 more clips. Here's the second to last one.
I just think we're seeing a reflection of the Silicon Valley ethos in the public market. The whole attitude was wait. You don't want to deal with an IPO. But at some point, all those VCs need a liquidity event. It also suggests that they're not very good at valuing companies, and it's not a very efficient market when it comes to late-stage companies and evaluating IPOs. Zoom is a nice alternative, but, Pinterest waited, Lyft, Uber, all of them, I think that's a real challenge.
So what he's saying here is that investors need this payout, and they're waiting, and it's just kind of like been their ethos, or their modus operandi, as Rush Limbaugh says. Modus operandi? I don't know. It means this is just how they operate. And it looks like they're doing a bad job of pricing these companies when they come to public offerings. What I really wanted to include this clip for, though, is that Mark Cuban did say Zoom is doing pretty well, and that is kind of set aside and an exemption, or something to put a caveat to all these IPOs, that Zoom is actually doing pretty well. And I've talked about it before, that they are profitable, which was the unique thing and what really intrigued me to them. And I think they're a really well-run company, and they have a lot of potential to growth. And whenever a billionaire kind of agrees with your opinion, you got to throw it in there, right? So that's what I did with that clip. Now this last clip, and this is a really good point.
A lot of VCs, they're not in the business of investing early anymore. They prefer to invest later and later with a higher success rate. And when you have a bunch of unicorns, even if they're, paper unicorns, it looks good in your portfolio. I think CEOs and employees are going to be smarter. I think the biggest impact is going to be on the choices employees make. And so you went from, hey, I'm early, I'm going to get a ton of stock, or maybe I've come in 4 or 5 years in, I'll have stock, it'll appreciate, I'll make a lot of money. I mean, how can you continue to do that as a potential employee for a lot of these Valley companies? You've got to ask yourself, will I make any money or much money at all?
Now, this is the great point that I wanted to end on, is the people in Silicon Valley are giving up salaries for more stock because they believe in the long term that there's a payoff if you can be successful. Now, what if these companies aren't going to be making money off that stock? What if those employees, what if the CEOs, any of the management who is banking on these stocks to give them a payout in the future if you perform well? If that's not guaranteed anymore, Mark's saying that that's going to impact the hiring ability of these companies. which means if you are not in Silicon Valley, if you are not a startup, but maybe a small business, a mid-level business, or even these big corporations, talent should, in theory, start looking for more places to live, less of like places that are more affordable, that have a higher salary, because the sure thing of stocks going to be paying you off if you hit it big is no longer there, which will make a greater opportunity for those other companies in other places that aren't siloed in Silicon Valley, Silicon Beach, Seattle. So if you are looking for talent that would typically just stay in San Francisco, it might be a good time to start reaching out to them. And conversely, on the other side of the coin, if you are a startup in San Francisco, in Silicon Beach, or Washington, just know these challenges are going to be ahead, and you may have to spend more of your startup seed money and your early series funding on employee costs, because they're not going to be so tempted and lured with just shares of a company. So there's a lot of dynamics to this. It's really interesting. It's not just the IPOs and their performance doesn't just impact investment portfolios and your investments, your 401ks. Hopefully not your 401ks. Your 401ks shouldn't have IPOs in them. But it has ramifications to the rest of the economy as well. And that's one of the things that I love about economics and investing, is because there's so many different things to explore and to wonder about. I just find it absolutely exciting. Now, let's go out and be successful together.